Hello guys, welcome back. So Estee Lauder was suggested to me by one of our subscribers, and I thought it's an interesting case. As I was taking a little bit of a deeper look at the company, I actually considered this one to be an interesting case study as well. And so in this video, we're going to be taking a closer look and also dive in some finer details here, which are not immediately obvious. You kind of have to dig through them a little bit. So, the first thing that you see, and one of the core reasons why this was suggested to me, is that it has been down a lot. You can see that its 1 year high is near $300, and it's down like 50% till that high. Actually, more than 50% if you go a little bit earlier in 2022. You can kind of see it here. The stock was like more than 350 at some point. So, it's down significantly, like more than 50%. So, while this happens, people are curious, is it a good opportunity? This is down a lot. And why is this down so much? This is also a consumer defensive company, although it's a cosmetics company, and I'm not so sure about the defensive stance of such a company. But it is, it is household and personal products, and there is a measure of, women pretty much wanting to buy these kinds of firms. Although I could say that there is something to say about the more luxurious nature of Estee Lauder, but still, more than likely it's going to continue selling really well. Now, interesting things to see here. Even after the stock has fallen off a cliff, the P/E ratio is sitting at 57, and it's still really, really high. That used to be significantly higher, for instance, more than 70 at some point, but still sitting at 57.6. And even though it's down a lot, the reason for this one is the fact that the net income hasn't been impressive lately, so it has been going down as well. That's the profit of the company. A very interesting thing that I noticed here is negative free cash flow in the past few quarters, and I was very, very curious about this one, and I ended up investigating a little bit and examining what happened, for which we're going to talk about a little bit later in the video. Now, the company has been buying some shares, but they have been a little bit conservative with buying, which makes sense because the stock doesn't seem to be too cheap at the moment. Of course, we're going to examine how cheap or how expensive it is a little bit later again in the video, when we're going to be examining our discounted cash flow model, which will tell us more about the actual price of the stock. Now, interesting things to notice. The fact that the company has a very high debt to equity ratio, which I don't really like, pointing to the company having quite significant amounts of debt here. And when this happens, I really, really want to be finding companies that, if I'm willing to take on these companies, I want them to be making tons of money and continue to grow at a rapid pace. I really dislike seeing that much debt. This debt actually can be one of the very, very core reasons why a company can go down, and I really dislike seeing such debt, especially in a company again that is not really growing that much and has been having troubles with free cash flow and net income lately. Now we're going to talk about what happened with the free cash flow, but generally speaking, their net income hasn't been impressive, and I'll show you exactly what I mean a little bit later again. Now, the company is paying a little bit of a dividend as well, but it's not significant, and the payout ratio has been massively affected because it has been dropping. The net income has been dropping. So at some point, I could pretty much see the company also dropping their dividend yield here, like cutting down on their dividends as well. Another interesting thing to notice here, which can also help or at least take the stock down for a little while, the stock price that is. Now, this is not a company that we're going to be buying for the dividend, of course, but we do want to examine the first pass that I want to do is the income statements of the company. And looking at this, I was kind of curious to check what was happening like 10 years ago, and the tool actually allows me to do that. And remember, all our patrons have access to this tool at myinvestorsheaven.com. You can find all the links in the description box below this video for your viewing pleasure. And so, you'll see that back in 2014, that's many years ago, like almost a decade ago, the company was doing 11 billion in revenue. And last fiscal year, they did 16 billion in revenue, which is not that impressive, frankly. It's not horrible, of course, but it's not super impressive either. And for many, many years, the company has been sitting around this range. And 2022, 17.7, 16 here, 14 here. So it's not a company that's growing at a tremendous amount, but it's also not a company that is crawling, is an interesting thing to see. It's almost like a sort of like low to medium growth company. Now, as I was taking a little bit of a look at the margins, I saw that the margins of the company have been suppressed. And you can kind of see it again in our tools here with our metrics page, where you will see that the net income margin, for instance, here has been dropping at like 6%, and the gross profit margin also dropping here. So I was curious to see what was happening, what is happening with this one, and I was taking a little bit of a look at some previous articles. This one, for example, mentions that in fourth quarter, that's the latest quarter, the adjusted gross profit of the company came in at 2.4 million, that's billion, 2.4 billion, down 3% over a year, and the gross margin contracted to 68%. So I kind of went back a little bit, and I examined that in, again, a little bit more detail. The income statements here, the page can give us the quarterly as well. And you can kind of see here what the article was talking about, with the gross profit kind of going down to 68% from 71% that was 4 quarters ago. Again, that's Q4 2023, 2022, like a year ago. And you can kind of see what the article is claiming here, the fact that we're having a little bit of a contraction here from a year ago. That's 3%. It's not significant, but it's something to note, the fact that gross profit has been going down a little bit. And the other interesting thing to see is that the balance sheet again of the company has been, again, the total equity of the company has been growing at a pretty slow pace as well, with some years being in the negative. You will see that 5 years ago it was like 4.4 billion, that's the total equity, and right now it's like 1.1 billion extra, like 5.5 billion. But the most interesting thing that I examined here is you will notice that the net income came down quite significantly in 2023, and again the article is telling us about this one, about the fact that there has been an issue here with the overall net income of the company, with downside was caused by the absorption of overhead in its plants stemming from the pull down of production during the year, and this is the core reason why the operating income of the company went down quite a lot, and the net income as well, of course, following that. Another interesting point, the thing that I mentioned earlier, the free cash flow. Now, the free cash flow here is in the negative, like 1.6 billion. And you will see that the capital expenditure of the company last fiscal year are 3.3 billion. And I was curious to see that. I was like, why is this happening? And the previous years, like capital expenditures were like $1 billion, 600 million. And so I became curious about this. And again, the tool allows me to very, very quickly jump into the forms and see what happened exactly. And so the way to do that is basically you visit our stock analysis page. Actually, it's, sorry, I'm always forgetting the company analysis page, yeah, SEC filings is where it is. There's quite a few tools here, so sometimes it's tough to find some things. And so 10K over here, so you open this up, and I have it opened up over here for you. I was looking for capital expenditures, as you will see, and you will see the capital expenditures here, they are denoted as $1 billion, but there is also the purchases of other intangible assets, and in some cases they can be classified as capital expenditures, bringing this down to investing activities of about $3.2 billion, and this is what you are seeing here. So in some, in some reported data, you will see this as part of capital expenditures. It's an intangible asset, and I wanted to see exactly what this is about. And so as I was looking at through this one, and I'm just jumping quickly through this one so that I spare you of the searching that I did, you will see that there was an acquisition of Tom Ford here, the Tom Ford brand, and again I was finding some asset acquisition. That's April 28th. Company acquired 100% of the equity interests in this LLC in exchange of $2.5 billion, exactly what was missing, in consideration of the Tom Ford acquisition. And as you'll see here, this is what happened with Estee Lauder and the extras in regards to capital expenditures. And it's always important to know why this happens and why you're seeing this decline, because in some situations it's a one-off, as in this case, and so it really pays to see what was happening. And the total cost of the asset acquisition in $2.5 billion is what happened over here. Again, very important to understand exactly what is happening with the business. Now, I'm going back again in our tool, and I will be visiting the stock evaluation page, stock evaluator here, the discounted cash flow model, which will now tell me whether it's an interesting buy. Now, we do know that the free cash flow was suffered because of the acquisition, but usually you will see something that would be more or less near $3 billion, frankly. And again, it's not going to be suffering so much. So this one is like a one-off, and it happens in many situations with companies. It's normal. Now, the revenue growth of the company, you will see here in our tool that the average has been 3%, but it has been severely affected by last year. So I do expect this to potentially be higher in the next 5 years as an average. However, I'm going to be a little bit conservative and I will start with this value, like 3%, and then I will go to something that is, I think, more normal, like 6 and 9%. And even 9%, I think the company could potentially achieve, frankly, to tell you the truth, after it has dropped 10% last year. I think it's achievable. Now, the net income margin of the company also suffered. We talked about why in the video earlier. Basically because of issues with manufacturing, pretty much. And the net income margin last year was like 6%, but overall it's something like 10% on average. That's the 5-year average. You can kind of see it here. Companies will have some ups and downs, of course, but you can kind of see that the average is actually, frankly, a little bit more than 10%. And so I will go with starting with like 10% being the average, and then I will go 13 and 15 here. With 13 probably the safest one. I think probably the medium estimates here will be closer to the truth, frankly. And the free cash flow margins that I'm going to use, again, the company is near 100, which is fairly normal. And so I do like to use something like 80 for my lower estimates. It's maybe a little bit too low. 90, which I think, again, is fairly normal, and 100%. So again, the medium projections, I think they're closer to reality, frankly, for the company. And I hit calculate, and you will see that we are sitting at about $90, frankly, in regards to our medium estimates, which I think are the ones that paid justice for the most part. Now 130 for our high estimates, which could happen as well, but the current price is at 161. And so what I feel about Estee Lauder is that probably is a one that I wouldn't buy yet, but I could see somebody, potentially wanting to play this one just because it has come down a lot, and it could be an interesting swing trade. But to me, a long-term hold for this one, I would probably want it to be less than 100, frankly, to tell you the truth, if I were to hold it for quite some time. I think it's a little bit more expensive than what I would like to chew here. And, they do have some headwinds here in regards to their revenue and net income. So, even though their free cash flow went down for a reason, I do think that it's still a little bit expensive, even though it has fallen down a lot. And again, that's what happens when when there's companies where the stock price has been climbing for not much of a reason, and it was like super expensive. They can keep going down for a while till they reach their balance, and I don't really think that this is close to how much down it can go. Maybe, I mean, you can never really time the stock market, or of course I don't have a crystal ball, but I do feel that this has the potential of again going down, unless we have some sort of a like super bullish market, in which case there will probably be other opportunities as well. So I would probably avoid this one for now myself. But if you do decide to buy it, best of luck. And thanks for watching the video. If you're having your vacation right now, have a great time, and I'll see you in the next one. I will be making a few videos these days, as I'm having some vacation, so the production is not great, but I think it's good enough, and it's kind of like the old days. And thanks for watching. I'll see you soon, guys. Bye bye.